Welcome, and thank you for joining us. You're listening to The Educated Investor. On this podcast, we'll not only cover current events, but also ideas to help you possibly maximize your Social Security benefit, manage your taxes, and overall become a more educated investor. And now, here's your host, Jerry Blakely.
Well, hello, and thank you for joining us today on Householder Group's Educated Investor Podcast. Today, we'll be chatting about recession or not, and the midterm elections and the effect that it has on the stock market. We'll be chatting with Kezia Samuel, and Kezia has over 15 years of experience in the investment industry, having worked at firms like J.P. Morgan, Curian Capital, Jackson National, and several others. And Kezia has the Chartered Financial Analyst designation, and she's currently the Vice President of Client Portfolio Management at AssetMark. And AssetMark handles over $60 billion of assets, placing it amongst the nation's top third-party money manager firms. So, Kezia, thank you so much for being with us today, and welcome.
Thank you, Jerry. Happy to join you.
Well, we're delighted to talk to you today about what's going on in the stock markets with the election and the pending possibility we hear on the news just as of this morning. What is today's date? October 17th. The big news was the market went up a bit, and because maybe things are turning out like maybe we're not in a recession. Recession is always on the forefront, like waiting there as a threat to us. So let me start by just kind of asking you, what is a recession? What's the definition technically, and how do we know we're in one and that kind of thing? What's a recession?
Yeah, I'll start with, I'm not sure I'd be delighted or people are delighted to talk to me about the current markets and the state of the economy and the recession. But I'll take you for that, Jerry. So I appreciate you setting the stage there. And I think it is important to talk about what is the definition of a recession, because I think we tend to loosely define things and or use what I call as rule of thumb definitions. Now, often we have heard that 2 consecutive quarters of negative real economic growth, as measured by gross domestic product or GDP growth, is considered that we're in a recession, and which we did have in the first 2 quarters of 2022. However, it's not the only thing that is considered in order to technically qualify as a recession. What are these additional criteria in order to determine whether the slowdown that we're experiencing might actually be a recession? So these fun individuals, there's 6 individuals, I believe, that sit in the National Bureau of Economic Research, NBER, who are the official crypt keepers in identifying when recessions begin in the U.S. And they look at additional things like real income. They're going to look at unemployment rate. They're going to look at industrial production. They're going to look at retail sales. They're going to look at consumer spending. And they're going to construct a picture, Jerry, by looking at a variety of different indicators in addition to the actual GDP growth in making a determination of whether or not we're in a recession, and won't tell us, in fact, until after the fact when all these things are done. So that's the technical definition. Let me sort of hit pause there before we go into the debate of whether we're actually in a recession or not, but just to sort of expand on that general rule of thumb of 2 consecutive quarters is not the only thing that is used to actually measure a definition of a recession, but there are a whole host of other criteria that need to be included to get a full picture of the state of the economy and whether a slowdown is a recession. So let me hit pause there and see if that made sense before we dive into the debate of are we in or not?
Yeah, it does. And I want to ask you, and I don't know, when I was introducing you, I'm just looking at a note here like, oh, I forgot to even say this. As a chartered financial analyst, you are currently with AssetMark, the Vice President of client portfolio management there at Asset Mark. I don't know if I said that or not, but I'm bringing that up now to ask you this question as you're talking about the recession. I think people always, think of recession as the things you're talking about, the gross national product, those kind of things, as recession in the economy. And I know a lot of our listeners, being, clients of financial advisors that work with Householder Group, are thinking of recession like I'm looking at my portfolio online this morning, wondering, where my money's at the moment. I'm thinking of recession in the stock market. Is the recession in the economy the same as, do we say there's a recession in the stock market? Do we use that word for stocks also, or just for the economy?
Another great question, which is, a recession is often associated with the state of the economy. So in terms of how things work in the job market, et cetera. But as it relates to the stock market and the economy, while linked, are not one and the same. Right. And sometimes we tend to use these words synonymously or loosely to define the two. When you look at your portfolio and the pain you're feeling while looking at your statements, that's because the stock market is in a state currently called a bear market, which is when stocks drop 20% from its last high, which was set in January 3rd of 2022. So for a while now, we have seen the markets, it's down about 25% through last Friday's close using the S&P 500 index. That is a very different scenario. So the stock market can be in what we call as a bear market, which is a drop of that 20%, without the economy being technically in a recession, which is where we currently think we are. So there are two different things. They're linked, but they're not one and the same. And often the stock market tends to be what we call as forward-looking. So if you're sitting in a car, you're looking at out that front window, looking ahead of what's anticipated to be next. That's the stock market, anticipating where the economy may be headed. Whereas the economy itself is like driving by only looking in your rearview mirror, things that have already happened. And the news that comes out in the economy is always after the fact. So they are two distinct things that take its cue from each other, but not necessarily timing appropriately with one to the other.
Okay, well, that makes sense to me, and I know you're about to define, more technically about the recession in the economy, and do we have one or not? What's it take to get there, and all that? I'm still back on the stock market in my thinking. Like, do we have to, because we're toward that bear market territory? We know that stocks are down, and all this pending recession talk with the economy. Do we have to wait for the recession to end before stocks go up?
Not necessarily. And this is, I think, perhaps one of the biggest head scratcher for many investors, where you think about clearly stocks are going to be in the dumps if we haven't gotten a recession, or if we're going to get a recession, right? It clearly has to stay in the dumps. And here's what history tells us. And it goes back to because stocks are forward looking, because it anticipates the pain about to come. Mm-hmm. Similarly, so it tends to peak and fall before the actual economic recession begins. And we went back to the 1950s, Jerry, and we looked at every economic expansion and recession. And what we find is that on average, there is a 6 to 8 month lag in the fact that the recession starts. The stock market actually started to fall 6 months before the recession was actually declared, because it's that forward-looking estimator. Similarly, though, on the way out, the question that you asked, does it have to wait for the recession to end in order for the stock markets to recover? No. Same thing, from that 1950s data onwards, we find that stock market tends to recover on average 6 to 8 months before the actual recession is over. Again, in the anticipation that things will heal and stocks will recover well in advance of the actual recession ending. So something to just keep in mind. Now, each time, clearly the scenarios and the circumstances are unique, but historically speaking, stocks have peaked and fallen before the recession starts, and similarly recovered well before the recession actually ends, as a reference point. So something to keep in mind, if you're using the economy to make an investment decision, sometimes the timing of it doesn't quite work out.
Yeah, that makes sense, because I know the market is a feel good or feel bad thing. If people are feeling pretty good about things, the market's going to go up, that enthusiasm goes up. but maybe how you're defining how the recession on the economy has a bunch of technical data. We don't see that technical data until after it happens, like you said before. So that makes sense to me. So you were about to talk about more details. Does the technical analysis indicate that we're expecting a recession? Do you think we'll go there?
Yeah, and the debate that I constantly get asked, are we in a recession today, based on the fact that one of the things that this National Bureau of Economic Research that looks for this 2 consecutive quarters, the U.S. economy actually contracted, which happened in 2022. So surely we're in one. That's not as simple as that. As I mentioned, they're looking at a whole host of other things. And currently, I'm going to just point out to 2 things. There's a variety of things to measure, but 2 things that I think will keep them from officially declaring us in a recession currently. What are they? One, if you think about the U.S. economy, we're not quite the manufacturing, giant. Instead, we're a service-oriented industry. That's how our economy grows. We make intellectual property. We create technology. Those things tend to be much more service-oriented. And if you look at the service index, which there's an index by the ISM, which measures how services in the U.S. is growing, it tells you that we are still in an expansionary mode. It has clearly slowed, but it has not fallen below a key threshold that indicates when we're in a recession. So that's the first part. Services continues to be strong. Anecdotally, Jerry, go to a restaurant, they're still full. You go to a plane, it's still full. Right? So those things tell us that the service side of the economy hasn't fallen off a cliff, which is one of the key drivers of typically what happens in a recession. The other is the job market. We still are in this upside down world where there are more jobs open than actually people applying for it. And the unemployment rate is at a 53-year low at 3.5%. That the combination of these things tell me that we're not in a recession, but the risks clearly have risen. We are starting to see things slow. Just look at the mortgage industry. Right? We've seen mortgage rates double in the last 9 months, going from 3% to nearly 7%. It's taken a hit. So that's telling me that the risks of a recession has risen, but we're not quite in one today based on the broader state of the economy, as I've used pointing out the 2 things that we talked about.
Well, that's fascinating because, we go to restaurants, they're full. And I know even though they say, help wanted, every restaurant has help wanted, the job reports keep coming in that it's a very solid labor market right now. Is that right?
It is.
Yeah.
Historically, we've never had a recession with 3.5% unemployment rate, and where we have added on average 400 and some thousand jobs per month over the last 9 months. That's not how recessions start, with job growth and people getting wage growth as well. So, wages have been growing and slowing, but nonetheless, those things you just don't think of a recession that adds jobs and gives people raises all at the same time. So we are in this weird world. We acknowledge that has created the pressure of a recession probably going up in the latter part of 2022 to 2023. Not a foregone conclusion, but clearly the risks have gone up.
So it's a real moving target. I know nobody's got a crystal ball that works perfectly well at all. And I'm thinking a part of the equation must be, we haven't talked about it yet. I don't want to go into great detail on it because we've covered it in previous podcasts, but that's inflation. Does inflation probably have something to do with this recession or not?
Yeah, it is the big elephant that is making the determination of where things go and if we have a recession or not. So clearly on inflation front, there's 2 key things with inflation and the Federal Reserve. The Federal Reserve is a critical player in making the determination of our future, so to speak, Jerry. So we do think on the inflation front, inflation likely peaked. And the June inflation number that we saw of 9.1% growth over, the prior year, June 2021, was the highest that we had seen in 4 decades. And we've seen that headline number, the top line inflation, has fallen to 8.2% in September. So you kind of look at the big picture and you're like, okay, we're headed in the right direction. 8.2 is nothing to cheer about. It's definitely a very high number, but directionally going in the right way. However, I think there's something that one of the reasons the markets have been so jittery and worried about this recession is this core inflation. Now, core inflation basically takes out food and energy, two very volatile components of inflation, pulls it out of that big picture inflation number. And when we look at core inflation, it's in fact been rising. So unlike the number I just shared from 9.1% in June to 8.2 in September, this number is actually going in reverse. It's gone from 5.9 to 6.6%. So you may go, well, why would that be the case? Because energy prices have come down from the peak at a boil in June in the summertime. So what gives? What gives and why is core inflation rising? And that's because two things are driving this. One, wages. If you look at we're a service-oriented industry, wages drive a significant component of how we price our service, and wages have gone up. And the only way to send wages down in a really strong job market is to fire people, right? You don't give them a wage cut after giving them a raise as a way to describe this. And because wages have gone up, it tends to have a lagged effect in how it tends to come off in inflation. That's one, wages. The other is rents. If you look at shelter prices, now home prices have started to come down. Thankfully, for those that are in the market looking to buy things, home prices have come down, but rent tends to lag home prices by 1 year. Why? Because no one's signing a lease for 1 month or 1 day. They typically sign a lease for 1 year. And so even though home prices have started to come down, rents will likely stay high for a period of time. That 1 year lag that we talked about, these two things are coming through in that core inflation number, which is why even though the Fed wants 2% inflation from where we are today, that's not going to happen overnight. And that process to get inflation to 2% by raising interest rates so sharply is what is causing the likelihood of a recession to happen. So just rounding out the conversation between recession, inflation, and Fed, they're all linked. It's hard to extricate one topic from the other, but that's where we are. The Federal Reserve's actions of having to raise interest rates so sharply, given this record inflation that has stayed sticky for a long period of time, and it's unlikely to come down to 2%, gives us the likelihood of a recession, the word coming up, to be on the higher end of the spectrum. Let me pause there again, Jerry, and see if sort of throwing a lot of numbers out your way and see if that made sense.
Yeah, I think it makes sense, and I'm thinking good news for anybody listening who is a renter that maybe around the corner rents will be going down. Bad news for people who are landlords, that they have to lower their rents down. But that's what's fascinating to me to hear you mention that. But yeah, we don't know if recession's coming or not. A likelihood it could if things continue is what I'm hearing.
Indeed. But I think this is where I think a segue is needed. When we think of this like recession topic, often we go to the worst, dark, damp, ugly place. We think of all recessions as being one and the same. And I think this is where some deeper analysis and discussion is needed. Are all recessions created the same? And in our view, no, not all recessions are the same. They're not all 2008. They're not all the COVID recession of 2020. While each of them are unique, can we categorize them? So if you allow me, I want to take a step into how should you think of recessions? Are there different kinds? And can we bucket them in a way that we can talk about what we're about to experience? Where would that be like? So if you don't mind, I'd like to sort of walk into that. What are the different types of recessions, and how should we be thinking about where we are today and what is likely coming our way if we have one, that is? Would that be okay if I jump in?
Absolutely. Go for it. That's why we're asking
awesome.
you.
All right. I love it. So let's just talk about what are the different kinds of recessions. Now, I'm going to break it up into three parts. If you look, we've gone all the way back to 1947, and there's been 12 recessions, even though, sometimes when I ask investors, how many recessions have we seen since 1947? I'm amused when I hear from the investor directly, must be 25, 50. We've only had 12 recessions since 1947. They feel very painful. Each is their own unique characteristics, but they fall into three categories. The first category that we see is something called asset bubble recession. Classic example is 2008, where an asset, the price of that asset starts to rapidly rise and disconnects from its fundamentals, eventually causing a bubble, and that bubble does burst. And when it bursts, it takes the financial system, the foundation of how we function, down with it. It's so deep that it cracks the foundation of the house. That's the first, asset bubble. Tends to be very long.
That's what we had in 2008, right?
Exactly. Okay. 2008 is a classic example of an asset bubble that cracked the financial system and took the global economy down with it. That's one.
Okay, I'm taking notes. What's number two?
I hope you're writing down, Jerry. The second is geopolitical, right? And geopolitical is like a shock to the system. Think of this as something that comes your way that you weren't seeing. An example would be the oil embargo. If you go back to 1973, 1974, remember the oil embargo?
Yeah.
All of a sudden, we didn't have energy, and it kind of hit your system. It's a shock. In fact, maybe COVID could also be used in this category. So think of this as an external shock category. And COVID, we didn't know what it was. Governments mandated shutdowns of economies around the globe. And that was a shock. We didn't know what to do with it. Clearly, a systematic shock. Now, the third, in this instance, it tends to be short-lived. Once the shock is, we figured it out, and we have a solution for it, we tend to move on. It's not a crash the system kind of a recession, geopolitical, or a shock-driven recession. That's the second kind. The third is what we call as, don't mean to demean this, a garden variety or a cyclical type of a recession. Think of the cycles of life. The saying, what goes up must
come down.
Mm-hmm. Exactly. So cyclical slowdown recessions are that classic type, in the sense that eventually we've gotten too high, we need to correct things, it comes down, there's a imbalance between supply and demand, those tend to rectify itself. It's just the nature of how things work.
Okay.
And cyclical recessions happens more often than the other two. Thankfully, right? We don't want these shocks or the asset bubble type. They're the most common types of driven, hence the garden variety descriptor that I added to it. This tends to be milder than the other two. Mm-hmm. It tends to be shorter lived. The drawdown in the economy in terms of how much the economy contracts tends to be smaller in size, and it also tends to be shorter in size. So what's the point of all this? I'm going to take the Jerry question, right? Jerry, when you asked, what does all this mean for an investor?
Yeah, right, exactly.
Right? What does this mean for the stock portfolio?
And I'm hoping you tell us that if we have a recession, we're in the garden variety cyclical type, the milder type.
I'm glad you asked, because where we see the current landscape, let's just paint it based on what is the economic landscape telling us, and what does this mean for the stock market is the second part that I want to connect these points to. First, let's take a look at what happened in 2008, and do we see that excess in the markets today, or in our balance sheets, or in our life today? Remember, Jerry, back in 2008, do you remember the ninja loans? The ninja loans stood for, the ninja loans. Now, we're not talking type 1 or we're not going in that direction, but it was a no income, no job, no problem loan.
Yes, right. Mm-hmm.
You remember those?
Mm-hmm.
That does not exist today, right? If you don't have a job, you're not getting a loan. The quality of the borrower is much better, meaning that people who shouldn't have borrowed their second loan to get that house, we're not seeing that excess being built into the system. So the consumer's balance sheet, through savings during COVID because they couldn't spend it, is much better placed today than comparison to 2008, where everyone was leveraged to the kilter. So that was one aspect to draw an example of how different today is, because the consumer is healthier, but so are businesses. Businesses have essentially shored up enough cash to prepare for what's coming. That doesn't mean every business has, but the broader landscape of corporations tell us that they're sitting on a significant cash balance to ride through an eventual slowdown. That picture of better preparation in your balance sheet or your household tells me we're so fundamentally different than 2008. So the likelihood is that we are likely going to see at some point, right? Recessions are just unavoidable. It's part of the cycle of how things grow, contract, and grow again. But today we are not in the same deep 2008-like scenario either. So drawing the difference and knowing the difference matters in where we are today. So I don't know if I'm delivering good news or bad news here, but the likelihood today, given this higher starting point, job market is strong. So if it sees slowdown, maybe those excess jobs start to disappear without having to lay off millions and millions of individuals like we saw in 2008. Those fundamental differences tell us that, if we see one, probably a cyclical or more of that garden variety, milder case of a recession.
I feel so much better talking to you now after hearing all that. That feels good. That's good to know. Now, really shine up the crystal ball, because here comes the real question. The midterm elections are coming. What impact will that have on the markets? Any way to predict what's from historical precedent as to what's happened during the midterm elections, as to what might be happening now, and how it might affect the recession in the markets?
Yeah, the first thing I'd say is put on your seatbelts. It's going to be a bumpy ride. And we know that rhetoric tends to be dialed up. And in the world of Twitter, live information, expect more of that coming your way at a rapid clip. Right. But what does all this mean? And I'm going to break it down into two parts. What have we seen historically in regards to the balance of power in our House of Representatives, in the Senate and Congress, that is? And then what does this mean for the markets? So here's what we've seen. And we've gone all the way back to, again, 1946 to kind of look at the data of what happens in midterm elections. And what we find is the first. It historically has been a challenging time for the incumbent presidential party. So it tends to be, and the impact we see is much more clear in the House of Representatives than it is in the Senate. So since 1946, the president's party, on average, has lost 25 seats in the House of Representatives in the 17 out of 19 midterm elections. So we've got quite a bit of data here.
Wow. Okay.
Consistency in losses. I don't know if you said, why is that the case? I think, it could be a myriad of reasons, including just dissatisfaction with what the party currently has done. And so it tends to be a referendum on the administration. This is just a guess. I don't know for sure. But generally speaking, that's the trend we've seen. On average, 25 seats lost in the House of Representatives for the incumbent presidential party. The Senate has shown mixed results, so it's always been a toss-up. The two exceptions, you may say 17 out of 19. So what are the two exceptions? 1998 and 2002. 1998, we had a really strong economy. So the incumbent president held on to their party lead. And 2002, if we remember, was right after 9/11's attacks. So voters rallied around the incumbent president right after that time period as well. But outside of that, in every other time, we've seen the House of Representatives switch from the incumbent president's party. So that's the balance of power in terms of what we have seen historically. Perhaps what we've seen in terms of what the markets tend to like is a split power in regards to that type of an environment. Historically, the markets have dealt better. Maybe it's because I don't know, we do less harm, however you want to see it, in regards to what changes can be done. I'll put that one to that's as much as I'm going to say on that effect of things. But what does this mean for the markets? And here's an interesting thing. Actually, if you look at the markets during midterm election years, they have a pattern. It tends to follow this pattern, which is in the first 3 months of the year, markets do well. Then in the next 6 months, second quarter and third quarter tends to slump, right before the election. It tends to not do so well. Maybe it's all the uncertainty about who's going to come in power, what are they going to do, et cetera. Markets don't do well. And then the markets rebound in the fourth quarter. Clearly, take that with a grain of salt because 2022 has thrown all of those historical patterns out the window. We have seen the markets only fall from the first quarter onwards. But here are two things that are silver linings. If you look at 1 year out after a midterm election, historically, using the S&P 500 as a reference point, since 1930, we're going way, way, way back, the average return on a 12-month period after a midterm election is around 13%, compared to 5.5% for non-midterm election years. Now, why would that be the case? Your guess is as good as mine, Jerry. I certainly don't know why this pattern holds, but that's what we find, that midterm elections, maybe once you digest the uncertainty and get past it, the returns are good because we haven't had that in the case. I don't know if it'll hold this time around, but that's what we've seen. Post-election, 12 months after, historically during midterm election, 1 year returns is around 13% compared to 5.5%. Only 2 instances since 1930 have we seen negative returns for that 12-month period. And you have to go all the way back to 1931 and 1939. And if you remember what was happening during those 2 time periods, both of those aligned with the economic challenge of the Great Depression. So, indeed. So what we have seen is that, look, midterm elections tend to make markets a little bit more volatile, but the after effect of a midterm election outside of the 2 time periods in Great Depression has historically been very strong. I'll end with this. Ultimately, politics tends to clearly pull on our emotional strings. It does. We tend to see red or blue. I remind investors that markets don't see red or blue. They just see the potential for green. In that, can companies make money? Can they continue to grow their sustained business? And can they navigate the challenges likely headed their way? So remember, we see red and blue. Markets only see the potential for green. When you look back at 100 years, going all the way back to 1926, all the way through June of 2022, I can't really decipher if there's a pattern that tells us that when you have Democrat control or when you have Republican control, one markets do better in one or the other. That historically is not the case. It tends to be a much more mixed bag than trying to draw a definitive conclusion. So using politics alone to make investment decisions historically has not been sound, let alone consistent in its offering based on what we have seen to date.
Well, I know that based upon everything you've just said there, and I've some of that information regarding the midterm and the regular term and so forth, I've experienced that. I've had that in my mind. But with the markets down right now, how far down are we off the top? Are we 18%?
We are down a little more than that, Jerry. This is where I'm going to bring some bad news. We're down around 26%.
26%.
As of 26% as of Friday's close on the S&P 500 as an example.
Well, I don't work with clients anymore as a financial advisor. I did for years, but I know historically when this kind of a thing, as I would explain to my clients, it's not guaranteed. But you know what? When the stock market's on sale, Usually nobody wants none. Now's the time to buy. It's probably going to go back up, and it might tie into this election, but we don't know that. You just select the average is a 13% increase in the year after. So we got to bite our nails and just kind of wait. So what do you think? What can we do today? Is there any way to protect against the market volatility, or what should investors be thinking in terms of what to do next?
And I think I'm glad you asked that question, because I think in the midst of volatility, we tend to focus in on trying to prognosticate or predict market tops and bottoms, which we know is a fallacy to do so consistently. Mm-hmm. Similarly, we try and predict when a recession starts and ends. Again, those things are impossible to time consistently. You may get it right once, but instead what investors can be doing is, working with householder group and financial advisors within the householder group in evaluating, do you have a plan that allows us to ride through the good, the bad, the ugly, which are all part of the investing life cycle? You're likely over the next 50 years going to experience something similar again. Incorporating that into your broader plan, I think, is one of the most critical aspects in having a successful investing time period. That's the first part. Make sure that you start your investing journey with a plan rather than a portfolio. Those two things are linked, but they're not one and the same. Just like the stock markets and the economy, they're linked, but they're not one and the same. One takes its cue from the other. Your plan should incorporate a variety of different outcomes in the markets over the tenure that you're going to invest. So that's the first part. Sounds simple, but often is missed out. The second is, rebalance.
Okay.
We've heard the adage from Warren Buffett's the great sage of investing: buy low, sell high. And you're often wondering, how do I do that? I'd love to do that. Well, you can do that by doing something as simple as rebalancing. Think of what rebalancing does. Rebalancing is taking a portfolio, because you never have just one thing in your portfolio. You have a variety of stocks. You'll have stocks here in the U.S., some big, some small. You'll have some international stocks. You'll have stocks in emerging markets. You have similarly in bonds. You'll have it split across. Rebalancing requires you to sell things that have appreciated, have gone up in value, and add to things that have fallen in value. As an example, let me just go back to 2021, when we started this year. Had you done nothing, your portfolio likely would have had, your stocks would be way bigger in position, and the growth stocks, those technology stocks that were doing really well, those would have had a much bigger presence in your portfolio. Guess what's not working at all in 2022? Those technology stocks that were the darlings in 2020 and 2021. Rebalancing would have taken some profits and reduced some of the pain that you likely felt in 2022. It doesn't eliminate it, but it certainly allows us to put into principle the adage of buy low, sell high, without having to do much brain damage. The last thing I'll mention in here is, for those clients, you mentioned buying things on sale. We love doing that when we go clothes shopping. I like buying things, bags and shoes on sale. But when it comes to the markets, we just don't seem to care for it in the same way. When markets have historically dropped 25%, and that's where we are currently, looking out 1 year, 5 years out, historically, that's when we get the biggest bang for our buck. That doesn't mean volatility is not going to go away. That doesn't mean that, this is it, this is the bottom. That's not the call I'm making here, but rather knowing that as an investor, when you go into the equity markets, you invest for the full cycle. That's 5 to 7 years out. And historically, entering when the market is down 25 has proven to be a great return time period for those longer term investments. So again, we like our sale in every other aspect in life, but when it comes to the markets, we seem to have an absolute gut-wrenching time in accepting that if you can lean in and your time period allows for it, you've got longer time period, and or your risk tolerance allows for it, this is when the outsized returns are made. So here's some things that we can do, which is, again, make a plan, Make sure it allows for these types of events to happen, not just today, but likely in the future. Rebalance, do the simple things, allows you to buy low, sell high. And last but not least, you can lean in should you think of, if it allows it within your plan to add things on sale.
And that's why the beauty of working with a financial advisor, so that the emotions are not there and you get a plan, you kind of look at things logically, and hopefully the advisor is, engaging the client in these kind of discussions. Certainly if you can figure out a way to buy low and sell high, the things you just mentioned, do that. That is a very good plan in a time like this. I'm looking at the clock, Kezia, and I know we talked about half an hour. We've gone a lot longer than that. We've had a lot to talk about today.
That's what happens when you get a chatty Cathy like me on the call. Sorry about that, Jerry.
No, there's just lots of information here today. Well, Kezia, I want to thank you so much for joining us and being with us here today and sharing your expertise with us. And I want to wish you well. And we've had a couple of times to chat like this in the past, and hopefully I will talk to you again in future interviews.
That sounds great. Thanks for having me again.
Okay, thank you very much, Kezia. I want to thank everybody for listening to today's podcast of the Educated Investor with Householder Group. And I've been your host here, Jerry Blakely, wishing you well. Until next time, onward and upward.
The opinions voiced on this show are for general information only and are not intended to provide specific advice or recommendations for any individual, nor intended to be a substitute for specific individualized tax or legal advice. We suggest that you discuss your specific situation with a qualified tax or legal advisor. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including possible loss of principal.
The information provided is for educational purposes only, is not a solicitation, and should not be considered investment, legal, or tax advice. Information has been drawn from sources believed to be reliable, but its accuracy is not guaranteed and is subject to change. Investors seeking more information should contact their financial advisor. Finally, investing involves risks, including the possible loss of principal, and past performance does not guarantee future results.